Mila, this is question 3, and it's all about financial statements. We have information relating to Drake Limited, which is a company that sells goods at a markup of 50% on cost. Highlight the 50% on cost. We will use it later on. Then it says pre-adjustment trial balance for the year ended 28th of February 2024. Highlight that as that marks the end of our financial year, meaning that our financial year started on the 1st of March 2023. I'm just going to ignore everything and just go straight to my nominal. And under my nominal account section, I have sales, cost of sales, debtors allowances. You know, when you have debtors allowances under nominal account section, you will immediately take that and close it off, or basically subtract it from your sales amount. All of this will be recorded in the statement of profit or loss. When you go to the statement of profit or loss, from sales, we will subtract that 350 that relates to debtors allowances. Everything was pretty much entered. Everything that is under nominal account section has been entered in the statement of profit or loss, as well as the notes. For these notes, please check out the link under description. Click on it, and then you'll get to access PDF. It's PDF documents that relates to these notes. And then there's an extra question there, which is question 4. That one, it's still grade 10, 11, 12 paper. I just modified the 2021 June exam grade 12 paper to make sure that it suits everyone from grade 10 to 12, especially if you're studying financial statements. I'm going to go straight to adjustments. The first adjustment says that Drake issued a credit note. Wow. So I guess when you issue a credit note, you know what needs to happen. For 6,600 to a debtor, Kendrick Lamar, as goods were not ordered by Kendrick Lamar, this transaction was not recorded. Basically, what happened there is we as Drake Limited, we sold goods to Kendrick Lamar, but then we supplied the goods that Kendrick Lamar didn't appreciate, that he didn't order, even though he started the whole thing. And those goods were returned back to us. And when goods are returned, please remember this. I emphasized this in the previous videos. Those were warm-up videos to the main meal. This is the main meal. This is how it will be asked in the June exam. And as a warm-up, I gave you the notes and I said, you need to follow those notes. Check out question 1, where I explained everything there. This has to do with the return of goods. So when goods are returned, these 4 accounts will be affected. First ones will be debtors allowances and debtors control. Those will be affected at cost price. Remember this? What I'm going to do with that 6,600, the first thing I will do, because it increases debtors allowances and already debtors allowances are subtracted from sales, we are going to take it straight to sales and subtract it from sales. So we will subtract 6,600 from sales. At the same time, it reduces what this debtor is owing us, which is Kendrick Lamar. And we are going to go to our debtors control, which is in trade and other receivables. From the trade debtors, we will subtract the selling price of these goods that were returned, which is 6,600. Because it affects 4 accounts, please note that the other 2 accounts will be cost of sales as well as trading stock. Remember, cost of sales will decrease when a debtor returns goods. So for us to be able to do that, we first need to calculate the cost price. To calculate the cost price or cost of sales, you will take 6,600 times it by 100, divided by 100 plus markup. Our markup here was 50%. I asked you to highlight it, and we are simply going to add 50% with 100, which gives us a denominator of 150. That cost price that we get, which is 4,400, we need to subtract it from cost of sales. And at the same time, because it represents goods that were returned, we are going to add it to trading stock. That's it. Because we don't have trading stock, I don't need to worry about trading stock part. And that is it with the first adjustment. The second adjustment, it says that only 80% of commission income was received. Only 80% of commission income was received. That means when you go to your pre-adjustment trial balance, commission income there is it's 4,560. That 4,560 is commission income received. And we were just told under adjustment that we only received 80% commission income. So that 4,560 is the 80%. Sound like a politician right there. It is the 80%. What I'm going to do is just to show it to you as part of the workings. Um, it means that that 4,560 is the 80%. We are missing 20% to make this 100%. The missing 20% is what we call accrued income, which is an asset. It will be recorded in trade and other receivables. Now, to get that, we are simply going to take the 4,560, multiply by what we want. We want the accrued part, which is the 20%, divide by what you have, which we have the 80%, which is the commission income that was received. And when we do that, it will give us what is outstanding, what we have not yet received. We have earned it, but we have not yet received because it's within our reporting period to have earned that. And unfortunately, we haven't received it. So it is owed to us. It means we provided a service for these people and they still haven't paid us our commission that is due to us. So they owe us. And that also means that the commission income that we recognize, since it is only the 80%, we are missing 20% to make it 100%. That is why you're going to go to the statement of profit or loss. And when you get to your commission income, you will add the 20% that is missing, which is at 1,140 to your commission income. And that will give you a total commission income of 5,700. The same time, note that you credited commission income, you debit accrued income, which is your asset. Accrued income is recorded in trade and other receivables as such, and that will be 1,140. That was B, adjustment B. Let us go to adjustment C. It says that, I like that word included because it's very important. You guys just jump to conclusions like you will be in Olympics. Where are the Olympics this year? Aren't they in China? No, they're not in China. Where are the Olympics this year? Man, and I was following it up. Oh, there's that boy from Botswana. Is it Lesego? Lesego. Yeah, yeah, that boy can run. He can run. But anyway, wherever they are, when we talk about being included, it means it was added. Okay. But you guys, as I'm saying, you dream about being in the Olympics and you just jump into conclusions sometimes without reading the adjustment carefully. Now, included means it's already in there. It is in there. Sometimes they'll say paid, but immediately when they say paid, you must just know that it's included because whatever we have paid is already in the trial balance. Unless at the end they say this transaction was not recorded or no entry has been made. That's when you can say, oh, okay. Now that one you will treat it differently. Guys, I showed you two videos where I treated insurance differently. So it's one of the two. Okay. Now question is, which one is this one? Roboto, right? At 25,000 rand, because they said it was included and it was included in our insurance in the pre-adjustment trial balance, is 75,000 rand. So that 25,000 rand has been included in that 75,000 rand, right? And it was paid to Outcall. Yeah, no. Outcall on the 1st of December 2023 for 10 months. So we paid 2023. December is 2023. December, January, February, December, January, February. So 3 months of this insurance falls within the current financial year. And it was for 10 months. That means 7 months fall outside the financial year. You see, oh, that's 25,000 rand. We don't want the 7 months that fall outside the financial year. The other one, it's fine. They've been included correctly those 3 months. We don't care because they've been included. But had they said this was not recorded, please note that you will add them. But if they say it was included, it means they've already been added. So there's no need to subtract them. You only subtract the ones we do not need. Okay? Um, guys, don't behave like out cold and start apologizing for things. Just get your mind right. When you're in this, you're in that forever. And make sure you do it right. So what we're going to do is I'm going to show you my timeline. So I'll start with the beginning of the financial year. Guys, with me, if I was writing the accounting paper, I wouldn't honestly write all of these months, guys. In the exam, there's no time for this. There ain't time for this. So I will normally write March and Feb. And then everything in between, I just leave it open. And I'll write the key dates. Like, for instance, they said we paid this insurance on the 1st of December. I'll just include December. And then I will include all three of them. And then I will just identify my financial year. And then I know that from December moving for 10 months, it'll stop at what? I think it's July, I think. Yeah. Am I right? July, right? No, it's September. Yes, it's September. Since December, January, February, March, April, May, June, July, August, September. So on the 31st of September, we know that this period here, 7 months, fall outside the financial year. They were included already. In this 25,000 is included in that 75,000. We need to take it out. We need to only take out the 7 months that doesn't fall within the financial year, people. I don't know if this relates to video one or video two, between the two. Okay. As I've said, that 75,000 that we have in the pre-adjustment trial balance includes the 25,000 rand. But we don't need to subtract the whole 25,000. I know someone will take out the whole 25,000 rand and then put in the 3 months that fall within. And then they forget to record the 7 months. Because guys, the 7 months um that we paid for them. We haven't yet received the service for them, but we paid for them. So they create an asset. So here we are reducing an expense. When we reduce an expense, it increases an asset or it basically decreases your liability. In this case, it increases an asset, which is prepaid expense. Okay. Now, as I've said, included in this 25,000 rand is the 7 months that do not fall within the current financial year. So I'm going to take the 25,000 rand, multiply by 7 and divide it by 10. Sorry, guys, my daughter gave me flu. Yo, it's battering me. It's really battering me. And anyway, so when you take 25,000 rand times 7 over 10, it will give me 17,500. That 17,500 represents an a prepaid expense, which is an asset. So we are going to reduce our expense in the statement of profit or loss. Our insurance expense will be decreased by that 17,500 because we have not yet incurred it. We'll incur it next year. It's for next year. It's not for this reporting period. So yeah, that's it, period. So we're gonna have insurance expense. The actual insurance expense for this year is supposed to be 92,000. No ways. No, can't be 92,000. Now that will give us 57,500. Now that's right. That will be correct. All right. At the same time, that 17,000 rand, we turn it into an asset. From being an expense to being an asset, converting an expense to an asset. Because we have paid for it in advance, it will be recorded in trade and other receivables as prepaid expense. 17,500 it is. All right. All right. Let's go to the next one. It says audit fees include 12,360, which was paid in advance for the next financial year. That one we treated exactly the same as we treated C. So we're going to take our audit fees, decrease them by 12,360. And that is because that's an audit fee for next year, not for this year. We have not earned it. But we have paid, I mean, we have not incurred it, but we have paid for it. And the fact that we have paid for it, it creates an asset, and that asset we call it a prepaid expense. Again, in trade and other receivables. See, guys, once you understand theory, everything will be fine. And this is grade 9 theory. I was talking about there are these questions that are not in textbooks, are not in past papers, that examiners will just throw in there. For instance, where they'll say um, one of the inventory items was used for display purposes. And because, you know, when you go and buy a phone, they'll put a phone there for display that people will press and take pictures and blah, blah. But when they sell it, they won't sell it at the markup that they normally want. They'll probably sell it at a lower markup. And in this case, what happened is that that item that was for display, it was reduced, all right? Because it was used for display. So we had to reduce its value, its cost price. And I think it was around 14,000 rand. We had to reduce it to like 12,000 rand. We had to reduce it by 2,000 rand. Now the reduction in that inventory, when I did it with, I don't know, I don't remember if it was a grade 11s or 12. And I said, but we have never done anything like that. And I said, yes, I agree with you. Um, we've never seen it in any textbook. We have never done it anywhere. But do you remember what you learned in grade 9? Where I said to you, when you have an asset, what does depreciation do to an asset? It decreases. So anything that reduces that reduction of an asset, it goes straight into an expense. Just for instance, if I have trading stock worth 50,000 rand and I sell trading stock worth 20,000 rand, that trading stock will decrease from 50,000 rand by 20,000 rand. That 20,000 rand of trading stock that I'm selling, it changes to cost of sales. And that's the theory. That's why I love theory. I hate reading theory. I hate business studies. I'll never do those. I hate life science. I'll never do that. But accounting theory is it's rich. It's beautiful because you can easily just put numbers. It makes numbers look so easy. It's like mathematical rules. Once you know the rules, you'll never fail. People complain about Euclidean geometry. That thing is all about understanding the theorems. Once you understand the theorems, you'll never go wrong. It's like being a Christian. Once you understand the commandments, you'll never go wrong. If you're Islamic, once you understand the Quran, you'll never go wrong. If you're Jewish, once you understand the Old Testament, you'll never go wrong. That's how it works. Once you know the rules, you're sorted. Um, if you're a traditionalist and you know the rules, you'll also be sorted. Okay, let's move on. So what happens here is because I've said to you guys it reduces your expense, you understand what I say, what I mean by that. When it reduces an expense, it creates an asset. Okay. When it increases your your income, it creates an asset or it reduces your liability. These are the definitions you learn in grade 9. That's a definition of income. The one that I just gave you right now is the definition of an expense. Increases in expense reduces your asset and results in increases in liability, meaning that a decrease in expense does the opposite. And you need to apply these theorems and rules when you get stuck in the exam. And don't come back to me and say, but say we didn't do this. You know the theory. And that's what matters the most. Okay. Um, sorry guys. The man is killing me. But anyway, I've got flu here. And so what we call it in man. Yeah, no, I'm old school. Is it still in man? Anyway, um, it says that in the company has four directors. Oh, yes, this is why. Guys, check out the video on, I think it was June 2023 financial statements. You guys, everyone that is watching this, if you're in grade 10, 11, and 12, can actually check that video out. Obviously, if you're in grade 10, you will know which sections to leave out. For those that want extra practice and you're in grade 10, just go to those videos, check them out. The principle is the same. You just avoid shares and retained income because we haven't done those yet. But everything is pretty much the same. Um, so this one reminds me of that one. So guys, you need to break it down. Break it down, break it down. Um, and once you break it down, it'll make your life easy. Think of grade 8 maths. Just break it down in little pieces and it'll make your work so easy. Easy, 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 easy. So it says we have four directors, right? Okay, good. Cool. That doesn't really help us. One director resigned on the 31st of May 2023. Whoa, you stop right there. May 2023, highlighted. If this resigning means from May, they were no longer there. And this is where people get confused when you have disposal. Guys, when you have disposal, you look at the beginning of the year until the day the asset is disposed. When you bought a new asset, you look from the day you bought it until the end of the year. It's not about you having it. You have to ask yourself, do we have this thing? If you have an asset, you depreciate it. You have someone that says an asset was sold in March, but when we want to calculate depreciation, we want to calculate depreciation from March until the end of the year. How? It was sold. From March until the end of the year, it's not there. So you can't calculate depreciation for that period because it's not there. It's gone. Understand what you're doing all the time. Please understand what you're doing all the time. So in this case, this person left on the 31st of May. So after the 31st of May, we can be paying them. So we're going to pay this person. Our beginning of the year is March. So you're going to pay this person in March, April, May, 3 months. So this one, we know that if director's fees was X, it will be 3X for one director. Remember, there's four, three more to go. Let's read. And then received his fees up to this days, which is good. Had they said they did not receive their fees for May, then it means we're gonna have 2x. Because we have director's fees that was in the pre-adjustment trial balance. So that means it includes this 3x, right? Then it says one director is still owed fees for January and February. They're not saying anything about the other directors. So out of the three that is left, one was only paid for 10 months. So we're gonna have 1x times 10. And then the other two, they worked for 12 months. So we're going to have 2x times 12. Then that should give us the director's fees that we have. Why am I doing this? It's for me to be able to calculate how much is missing, which is, in this case, I can tell it's accrued expense. Yeah, it is accrued expense, right? Yes. An increase in liability creates a liability or reduces your assets. So it is accrued expense, which becomes a liability. You see, guys, I'm simply using grade 9 um, principles here, the definitions. When I tell my kids that if you don't know the definitions in grade 9, the ones that I taught from the beginning of grade 9, please do not take accounting. They think I'm rude. Um, they just don't understand how important it is. Once you know the definitions, you are sorted for life in the life of accounting. Once you know the accounting definition and then you understand the accounting equation, you are sorted until you get to your fourth year and you become a chartered accountant. Accounting is all about the accounting equation. We just break it down. That's what they do. Okay, when I do this, this is how I'm going to do it. I try to cater for those that love pictures. So key dates for me is the beginning of the year, the end of the year, 31st when we got rid of one director, and then the 1st of January, it's when we know that the other director we stop paying. So the other two is for 12 months. This will give you our total director's fees, which is an expense. It'll be 3,330,000. How if I broke it down nicely? I have explained this already. I'm just giving you a picture. Let me just take it back. You guys need to appreciate us. So it takes so long to do these things. And it's just for you guys to enjoy. Check this one. A director, I did it in red or orange or purpose. It's because this director is gone. So they only worked for 3 months. And then we have the other two directors that worked until the end of the year, and we paid them for the entire year. But there's this one director that was not paid for January and February. So that's why that one will be 10x. So this represents everything that we have paid towards the directors. And here it'll give us an amount of 3,330,000. How do we know that this is the money paid? Because it is there in the pre-adjustment trial balance. And this is another issue where I say if you didn't do well, if you didn't get 60% or even 50 in grade 9, you shouldn't take accounting in grade 10. It's because of things like this, because it means you didn't understand the generals in grade 9. And if you understood the generals, you'll understand what is going on. Let me just tell you a background about that 3,330,000. We paid it, right? So in which general was it recorded? You see, CPJ, because we paid grade 9 stuff. Okay. So from the CPJ, it went to the general ledger. So if we paid this every month, we kept on taking it to the general ledger, general ledger, general ledger, general ledger. At the end of the year, in total, we paid in the general ledger under director's fees on the debit side. We have 3,330,000 sitting there. And then we prepare the pre-adjustment trial balance, right? This is grade 9 again. So in the pre-adjustment trial balance on the debit side, we have director's fees, 3,330,000 rand. At the end of the financial year, though, we're like, whoa, wait, we need to account for expenses. And expenses are not about what you paid. It's about what you have incurred. To incur is anything that helped you run the business in the current financial year. All the costs that helped you run the business in the current financial year must be recognized as an expense. And you notice that actually there's one director who helped me run the business for the entire year, but I didn't pay them for those 2 months. And those 2 months, I'm being unfair for not recognizing it because this person was here in the business working for us for those 2 months. They help us earn that income, which is the matching principle. We spoke about it when you did GAP principles. So we've made money from using this person for those 2 months. So it makes sense that the cost of making that money, we need to recognize it as well. So now it creates an increase in your director's fees. Director's fees, remember, guys, must be shown separately. We did this again in grade 9 where I gave you a list of your expenses. Director's fees was there. It's just salaries and wages paid to directors, but we don't add it to salaries and wages because we need to know how much directors are earning because they are the ones that are responsible for preparing financial statements. If we leave it in their hands, they will rob the company. Ask Marcus Eustace and other people. Um, Unfortunately, including our government, which is so unfortunate. It's so sad, though. People are heartless, eh? Oh, man. And that KPMG guy as well. Do you know how many poor people could have benefited from that bursary? Ah, people are sad. You know the guy, the easy ways of making money and be rich and set for life. Yeah, I see Zuma kids trying to come back to politics and all that. And I'm like, guys, your dad was a president. You could have just used this to make so much money without having to come back. But anyway, what can I say? Um, what I'm gonna do is to add all my x's. So I'm gonna have 3x plus 24x plus 10x. that will give me 37x, and then divide both sides by 37, it will give me 90,000, right? It means each director per month was earning 90,000, right? But we want those 2 months that are outstanding, which will give us 180. So we need to take this 180 and increase our director's fees by that 180. There we go. Director's fees must increase by 180 because we are increasing an expense. And that 180 will create a liability or reduce an asset, okay? So in this case, it will create a liability, which is accrued expense. Accrued expense is recorded in trade and other payables. First years, please check this out as well. Benefit ideally. Um, and yeah, okay, let me leave it there. Sorry. Happy fingers. Okay, I'll need to go soon. Um, I don't know if I should stop and then record part 2 later or just continue it later. Let me see where I stopped. I haven't done these ones, but I have done these ones here. Okay, I've done E. Let me finish this page and then I'll do part 2 of this video. It says the repayments on the loan are fixed at 35,000 rand per month, including capitalized. So we know that interest is capitalized. I did this with my grade 10s when we did the general journal with all my accounting students. We did this in grade 10, but then I keep on building on it. But somehow students tend to forget. I don't know why they learn to forget. And then it says balances as per the loan statement. When interest is capitalized, guys, you have to prepare a table which starts with the balance at the beginning of the year. Then you're going to have your repayments. You put them in brackets. It must be for the whole year. Then you're going to have your interest and then you'll have your balance at the end of the year. So in case you're confused as to what I'm talking about, I mean this over here. So you're going to have balance at the beginning of the year, and then you will add you subtract your repayments. It must be, if it's per month, you multiply it by 12. It must be an annual repayment. You put it in brackets because it reduces what you were owing at the beginning of the year. Interest will increase what you were owing at the beginning of the year. It will increase your loan. And you will notice that here you will have 4,028,000. The difference though, you're going to take 4,028,000 plus 420,000 minus 4,175,000. The difference that you get there will be your interest. That interest, normally it's an expense. You debit interest expense, you credit the loan if it's capitalized. Okay. Check out the videos on general journal. That's where I actually explained this. I explained it thoroughly there. Videos on general journal. Just want to show you quickly what I'm talking about and then leave. Okay, here they are, here they are. So check out these videos here where I explained the entire thing as to what is going on when it comes to capitalized interest. It was something like this, and I explained it there. Okay, this is what I'm talking about. This is where everything comes from. Okay. Check out videos on general journal. Basically, I included them there. All right. So what I'm going to do, guys, please know that even though interest is an expense, I don't include it under operating expenses because it is actually not an operating expense. It's a financing cost. So it is shown separately on the face of your cash flow statement. It's very material. So the users of financial statement needs to see it separately because it tells them it will influence their decision makings, whether to invest in a company or de-invest in a company. So we're going to have 273 sitting there as interest expense, and we're going to put it in brackets there. Okay. For now, I'll leave it here. I'll continue with this video probably tomorrow. Now, Koto. Thank you for watching. Please don't forget to like and subscribe, share with everyone that you know. Koto.